Hello, everyone. I'm Michael Schrier, a partner here at Husch Blackwell. Before we begin, I'd like to cover a few housekeeping items. At the bottom of your audience console, there are multiple application icons for your use during the program today. If you have any questions during the webcast, please submit via the question box. I'll try to answer all questions during the webcast today, but if a fuller answer is needed or I run out of time, which will most likely be the case, it'll be answered later via email. A PDF of the presentation is available in the Program Materials folder. This program has been approved for legal education hours in certain jurisdictions. To report your hours, click on the CEU icon at the bottom of the screen. A certificate of attendance, including course numbers, will be emailed to you tomorrow, along with a recording of the webcast for watching, sharing, and your own personal enjoyment. Towards the end of the program, be sure to complete our short survey. We use your feedback to plan future programs that are applicable to your business needs. Okay, so with the preliminary matters out of the way, let's turn to the main event here. Thank you all for joining me today for Prevailing Wages and Apprenticeship, Uncharted Territory for Compliance arising from the Inflation Reduction Act. I'm presenting to you today because I've spent the better part of the last 20 years of my career working at the intersection of federal procurement and labor and employment law, which typically deals with prevailing wages and apprenticeship. And the current situation here on the Inflation Reduction Act is a very interesting twist on those tried and true federal contracting concepts. What I wanted to accomplish today is to do some level setting and some explaining of the Inflation Reduction Act. Because looking at the attendance sign-up for this program, there are a lot of folks who may be fairly familiar with the Davis-Bacon Act and apprenticeship, and there are some who I suspect may not be so. So the idea here today is to have this be sort of a one-on-one for all comers. So we're going to spend a little time at the beginning talking through what some of the basic concepts of prevailing wages and apprenticeship are, and then I'll get to how the Inflation Reduction Act modifies and twists it and tries to apply it all here. So let's get started. All right, so the important thing to remember here is the Inflation Reduction Act is a tax law and not a labor law. It provides a series of tax credits and incentives related to production and distribution of clean energy. Tax credits are increased or made available if the owner or developer complies with prevailing wage and apprenticeship requirements, hence today's conversation. The loss of tax credits or incentives and even additional penalties are authorized for non-compliance with prevailing wage and apprenticeship requirements here by the statute. Now, I'm not a tax lawyer, I'm not an energy lawyer, government contracts and a labor employment lawyer, but just want to sort of walk you through some of the concepts here and how and why this is important as you contemplate either developing new clean energy projects or being a contractor or a subcontractor on clean energy projects going forward. So how is this relevant? Under the terms of the Inflation Reduction Act of the IRA, these specific tax credits are available provided that you comply with prevailing wage and or apprenticeship requirements. And the two that I have asterisk there, back up, all of them require compliance with the prevailing wage requirements. The two with the asterisks are the only ones that do not also require compliance with apprenticeship requirements. So if you're looking to get any of these credits, you have to make sure that you make good faith efforts to comply with the legal underpinnings for prevailing wages and apprenticeship. So let's start getting into some of the basics here. What are the apprenticeship requirements under the Inflation Reduction Act? And this is a direct quote from the statute itself. For those playing at home or wish to revisit this later, but basically it says taxpayers shall ensure that not less than the applicable percentage of the total labor hours of the construction, alteration, or repair work on the project shall be performed by qualified apprentices. That's a pretty powerful statement. And it conditions the tax credits on rigorously complying with apprenticeship requirements. And so one more introduction on the prevailing wage requirements. Here it talks about, and again, this is a direct quote from the various points in time which it's mentioned in the statute. It basically says you have to pay prevailing wages at wages not less than prevailing wages for similar construction at rates determined by the Secretary of Labor in accordance with Chapter 31 of Title 40. In other words, the Davis-Bacon Act. I'll get a little more about that in a second. So as you can see from this slide and the prior one, the tax code here has expressly incorporated these two labor concepts as a condition precedent to being eligible for full tax credits. So that's why we're having this conversation today, to allow you to understand what's at issue, what the compliance requirements are going to be, and how things can go forward. So part of the way that I like to prepare slides and presentations is to provide all my participants here with takeaway resources. And so one of the things I have done throughout this presentation is to provide resources and guidance so that you can look at your own time at your leisure, probably mostly often when you are having trouble falling asleep at night. But here's a link to the statute. The IRS has its own webpage about guidance related to the Inflation Reduction Act. And then finally, we're going to talk about this quite a bit going forward, IRS Notice 2022-61, the only guidance so far that the IRS has published regarding wage and apprenticeship requirements for the tax credits. So basically going forward here, what I want to do is do a little level setting, sort of explain apprenticeship basics and prevailing wage basics, and to give a relatively simple overview of these concepts. And I'm going to leave out a lot of the complexity, because in the government contracting space, there are a lot of twists and turns, and this is frequently a place where even the best sometimes don't get full marks from the Department of Labor when they're audited. But just want to expose you to the concepts, and then we'll go through how these two concepts are applied in the Inflation Reduction Act, and then finally give you some, as I see, some issue spotting and some practice tips going forward. All right, so let's talk about the basics here. Apprenticeship. Apprenticeship is basically the formal learning process, teaching process to create a pipeline of journey workers for various construction trades. And federal law authorizes the Department of Labor to formalize trainings of journey workers through apprenticeship. And it's handled through the Department of Labor's Employment and Training Administration Office of Apprenticeship. So again, Department of Labor is going to be overseeing all this fun stuff. So the basic takeaway for apprenticeship, and generally speaking, not connected to the Inflation Reduction Act, I'm talking generally speaking right now, that there's typically no federal requirement to use apprentices generally on construction projects. But if you choose to use apprentices and they're employed, then you must comply with apprenticeship program registration requirements, and individual apprentices and workers have to be registered for apprenticeship programs. Typically, the apprenticeship programs are established by unions or construction trade organizations. Example off the top of my head, for an electrician apprenticeship program, typically the IBEW will run some, but then also various construction organizations like ABC will also run various apprenticeship programs. So that's how states and local governments sometimes run them too. It's a little bit of a hodgepodge, but it depends what trade is at issue. So the only programs registered with the U.S. Department of Labor's Office of Apprenticeship or an approved state apprenticeship agency may be used as part of the apprenticeship program requirements. And again, I'm just going to touch on a couple of concepts here, just to level set. It only includes apprenticeable occupations. We're not talking about generic laborers. We're talking skilled folks like plumbers, electricians, masons, stuff like that. That any apprenticeship programs have to have clear written performance standards. That apprenticeship programs typically spell out exactly what wages can be paid to apprentices, typically as a percentage of the full journey worker wage, and we'll cover that a little more in detail later. And also, apprenticeship programs typically are required to have their own affirmative action plan and promote equal opportunity for apprentices and applicants. Again, I think I touched upon this earlier, but each worker enrolled must be individually registered and have a written agreement with the registered program. And only those with a written contract are considered to be properly enrolled in the apprenticeship programs. Typically, I've seen apprenticeship programs generally run between 1 and 3 years long. Usually has a sort of a ladder progression for when the apprentice moves to the next level. Associated with that is also increased pay based on the percentage of the journey worker wage. All right, so I think that's enough for talking about just generic basics about an apprenticeship program. Again, if you're interested as to how these work generally, we can go look at these resources, at the statute, Department of Labor regulations, and Department of Labor guidance for how they interpret or apply stuff. And again, most of the time I see it that this applies to both union shops and merit shop use. There's typically no statutory requirement to use apprentices. Generally speaking, we'll talk about the Inflation Reduction Act in a second. But generally speaking, and it's usually a good source to get skilled labor because typically when folks graduate through these apprenticeship programs, they're actually able to do the work efficiently as a journey worker. All right, so let's talk next about prevailing wages. And so I'm going to talk about this in the concept of the Davis-Bacon Act, which is the granddaddy of all the construction-related prevailing wage statutes. And again, I'm going to talk here in the context of federal construction. Typically, think like building courthouses and dams, funded by the United States government. And so, as this is the template upon which the IRA is basing its prevailing wage requirement. So it's good to know about the Davis-Bacon Act first. I'm going to spend a little time on this to bring everybody up to speed. All right. So typically in the federal construction world, every federal contract for construction in excess of $2,000 is covered by the Davis-Bacon Act. You'll see that there are extensive regulations at 29 CFR Part 5. For those of you who are familiar with federal construction requirements under the federal acquisition regulations, there are a number of FAR clauses that apply to Davis-Bacon Act covered work. One of the interesting points about how this works in the federal construction world is that these contract clauses, these FAR clauses, are placed into the prime contract by the federal government, and the prime contractor then flows down these contract clauses to the subcontractor and requires each tier subcontractor to flow the clauses down to the lower tiers. Now, again, this is a 1930s law that's been refined over the last nearly 100 years. This is fairly prevalent in federal construction world. So prevalent that the same concepts have been applied in a number of other contexts. Most recently, the Infrastructure Investment and Jobs Act requires the same idea as what we have here. That they have to apply Davis-Bacon Act. Same thing with the National Housing Act and various other ones listed here. But the basic takeaway here is that this is a fairly well-developed concept of law as applied to government-purchased or government-financed construction projects. All right, so let's talk a little more detail about what's really involved here. This is the basic contract clause, typically from the Federal Acquisition Regulation, but it applies to pretty much all construction-related prevailing wage situations under the federal government. So basically, the highlighted portions are more or less the important ones here. All laborers and mechanics will be paid unconditionally and not less often than once a week. The full amount of wages and bona fide fringe benefits at rates not less than those contained in the wage determination. So again, this is just a quick level-setting discussion today. There's a lot of conversation that could be had about what constitutes a laborer or mechanic. There's a lot to be said about what does to be paid unconditionally mean. It's very clear that these tradespeople typically have to be paid no less often than once a week. Wages and fringe benefits we'll get to in a second, and at rates not less than those contained in a wage determination. So let's talk about what a wage determination is. Wage determination is created by the U.S. Department of Labor, and it's typically prepared annually or semi-annually, serving collective bargaining agreements in every county, city, state in the country, as well as sending surveys to non-unionized contractors to provide information about the wages and benefits they're providing their workers. And this is typically updated by Department of Labor, as I said, at least every year, usually every 6 months, on a county by county or region by region basis throughout the country. There are typically 4 types of wage determinations, as you see here. There's building, residential, highway, and heavy. And so take, for instance, in District of Columbia, for the District of Columbia, there are 4 wage determinations, 1 each for building, residential, highway, and heavy construction. So you have to, typically the contracting officer would determine which wage determination applies, attach it to the federal contract, and then the prime contractor would know, aha, this is the wage determination that applies because the government has said so, and this is the one I'm going to flow down to all my contractors and subcontractors. As we'll get to a little bit, the IRA changes that a lot. So we'll get to that in short order. But generally speaking, where do you find wage determinations? Well, you would go to a government website called sam.gov, and they have a whole mechanism here for finding wage determinations. Anybody can do it. You click on the buttons, and you can search for wage determinations. So, again, for those folks on the call who haven't dealt with this before, I'm going to spend just a couple seconds showing you what a wage determination looks like. So this is the top part of a typical wage determination. Again, I picked one at random here for the District of Columbia. This is from, as you see, it was issued in July of 2022, last summer. It's probably not valid anymore, but it's good enough for our discussion today. And it says this was for building construction, one of the 4 types. So again, this is just to give you a taste for what's involved. As you can see here, this is one screenshot from a long wage determination. It has a list of bricklayer, carpenter, millwright, and electrician, among others. And you'll see for each job classification, there's a column for the wage rate and a column for fringes. And so the important point for these prevailing wages is that not only do you have to pay the wage, but one also has to make sure that the fringes are paid too. And so the important point for this is that when you find the wage determination that applies to the jurisdiction in which your projects be located, you're going to want to look through and see all the job classifications, see what all the wage rates are, and see what all the fringes are that have to be paid for each job classification. So, all right. So let's talk about some of the payment. Again, this is all in a government contracts context. As I said before, the government chooses which wage determinations to attach to a contract. Wages have to be paid weekly. And we'll just touch on this briefly, but wages have to be paid for all time spent in each job classification. Typically, it's not a hard thing. If you have an electrician and he or she is on site only doing electrician work, simple. They get paid the electricity rate for wage and fringe, and that's done. But say you have somebody on job site who's doing electrician work, mason work, and carpenter work, all in the same day, let's say all in the same day. It can become a real record-keeping nightmare, because Department of Labor gets kind of persnickety about this type of stuff, and they want to make sure that the worker is being paid accurately for time spent working in each classification. And typically, Department of Labor, if they see that somebody's working in multiple classifications, Labor will demand to see very strict timekeeping records to know exactly how many hours are spent in each. And if those time records aren't there, Department of Labor will assume that the contractor would be required to pay at the highest rate for that week and time. So again, discussion for another time, but this is a source of a lot of frustration for a lot of my clients typically. Another issue that comes up is wage payments for apprentices. Typically for apprentices, as part of the apprenticeship agreement, apprentices can be paid a proportion or a fraction of the journey worker wage rate under the Davis-Bacon Act. So, in a 3-year program, a first-year apprentice typically gets paid, maybe 50% of the journey worker wage, and then over time, as the apprentice proceeds through the program, they get paid a higher percentage wage, and then upon graduation, then they get paid the full, prevailing wage, journey worker wage rate. And so there are issues about how to pay the apprentices, both the wage rate and also fringe. But again, discussion for another time, but an issue for issue spotting purposes for now. Also, there's another concept called conformances. I showed you a wage determination before. It had lots of job classifications. But what happens if you have a trade that's required on your project that's not clearly listed on the wage determination? That's what the conformance process is for. And Department of Labor has a whole procedure for how contractors are supposed to approach the Department of Labor to say, hey, DOL, we have a job classification here which doesn't neatly fit into the wage determination. We need a special wage rate and fringe for this job. Here's what we think it should be. Bless this and let us go on our way. Sometimes Department of Labor does, sometimes Department of Labor doesn't, and that's a whole other process in and of itself. So finally, another one of the issues to keep in mind for typical prevailing wage requirements is record keeping. For the employment lawyers in the audience or those familiar with Fair Labor Standards Act, there's typically fairly detailed information that needs to be maintained by employers regarding wages and employees. For prevailing wages, those requirements are beefed up a little bit. And so there's some expanded and categories of information that must be maintained. So I've spent a lot of time talking primarily about the wages. So let's talk just a second about fringes. As you saw in the column on the wage determination, there's a column for fringes. So, there are multiple ways that the fringes can be paid. They can either be paid in cash, which is, from an accounting purpose, probably the easiest way to go about doing it. The fringes can also be paid in bona fide benefits, such as through an ERISA benefit plan or something else. But regardless of which way you wind up paying the benefits under prevailing wage statutes, your pay records and pay stubs to the workers have to account for every penny of fringe to show that it was properly accrued and paid. You don't do that under the typical prevailing wage statute, Department of Labor starts looking at you funny, and problems typically ensue from there. So how do in the federal contracting world, how does this record keeping and how does this staying on the straight and narrow usually work? Well, one of the key compliance tools on the federal contracting front is what we call certified payrolls. A certified payroll is, it's a document, and I'll get to that in just a second. Let me just show you what it looks like first here. This is a Department of Labor certified payroll, and it's a little small on the screen there, but basically there are columns, for very detailed information, listing the employee name, the job classification they worked in, the hours they worked in each day, deductions, the wage rate that applies, and it goes on and on across the columns there. And then on the back side of the form, you probably see in the bottom right column there, there is a certification where the contractor who is doing the work and employing the actual employees has to certify under penalty of perjury that the information is correct. That's one of the fun little parts of the Davis-Bacon Act and generally applicable federal prevailing wage statutes. So if you ever want to see what a certified payroll looks like, there's the link for it. But the important points of all this is that these certified payrolls are typically required to be filled out weekly. Again, along with the pay cycle, as the statute and the regulations require that the employees be paid weekly, certified payrolls have to be prepared weekly. And they're typically forwarded to the contracting officer or to the higher tier contractor to show compliance. And obviously, the prime contractor and the lower tiers rely on the certified payrolls received to ensure that, okay, my subcontractor is, at least on the face of it, looks like they're fully complying with the prevailing wage requirements. Now, the big stick in the federal contracting context is that if somebody were to lie about it or falsify the information on the certified payrolls, it can and does lead to False Claims Act criminal and or civil liability. So that's the big stick to ensure compliance in the federal contracting space. All right, so let me throw one or two other little concepts, and then we can get onto the IRA stuff. All right, so first, one of the other issues that I could probably spend another 20 minutes talking on is the concept of what is construction versus what is maintenance. There are loads of cases about this. The Davis-Bacon Act covers construction and repair work. Another federal statute called the Service Contract Act covers maintenance services. Where construction repair ends and maintenance begins is a very fuzzy line, and it's very fact intensive. Needless to say, there's lots of litigation about that issue. But keep this in mind, particularly as we talk about some of these energy development projects, as to where the line is between repair and maintenance, because that's going to be very important. All right, so finally, the last concept from Davis-Bacon Act stuff generally. Again, I told you before that this is a federal statute. It requires that the contract clauses be put into the prime contractor's contract and then flow down. These are some of the enforcement mechanisms. Payment of back wages, liquidated damages. Okay, sure. But the real heavy stick is at the bottom there called debarment, which basically says that if a contractor doesn't comply, and typically it's some kind of willful or some variation on willful violation, then the federal government can put the contractor or subcontractor, whoever it may be who committed the violation, on the naughty list and bar that entity from doing any federal work for up to 3 years. So that's typically how prevailing wages are enforced in the federal contracting context. Again, it's going to be a little different, as we're going to talk about that in just a second in the IRA context. All right, so let's, again, for your resource, for your reading pleasure later, here are a number of resources you can take a look at to see generally how the Davis-Bacon Act works, prevailing wages work in the federal contracting context. Again, for those of you who are looking at the screen wondering what's this CWHSSA, I didn't talk about that before. That is effectively an overtime provision that's engrafted onto the Davis-Bacon Act. As we'll talk in a couple seconds, that concept wasn't incorporated by the IRA, but again, just so you have completeness, all that's there. So, the important points about the Davis-Bacon Act is that basically it's all fully enforced by the federal government. The clauses have flow-down requirements, and they're mandatory flow-down requirements, and that's typically how these requirements are enforced. And a failure to include the clause is its own Davis-Bacon Act violation, which the Department of Labor enforces regularly. And then, again, we talked about the various hammers that the government can use: withholding contract payments, contract termination, debarment, criminal liability, all that fun stuff. All right, you've listened to me clear my throat and level set for the last 30 minutes. Now let's get to the Inflation Reduction Act stuff that you've all really come here for. All right, so let's take this apart here for a second. So under the Inflation Reduction Act statute on prevailing wages, as I said, I showed you this language directly from the statute before. It says that that laborers and mechanics shall be paid wages at rates not less than the prevailing rates for construction in the locality in which such facility is located, as most recently determined by the Department of Labor. Now, what's important about this provision is that it does not expressly incorporate the Davis-Bacon Act here. It just says they have to pay rates in accordance with those that are put out by Department of Labor for Davis-Bacon Act purposes. But it doesn't expressly engraft Davis-Bacon Act requirements, which makes this a little weird because, as I showed you before, those other 70 statutes, typically they expressly incorporate the Davis-Bacon Act into it. This is being different. Now, you look at this going, okay, shall be paid wages at rates not less than. Well, and you say, well, you showed me a wage determination earlier that had wages and fringes. Have no fear. Treasury, when it issued one of its only notice as to how to interpret the IRA, adopted some Department of Labor regulations that defines wages to include both the wage and the fringe. So there we go. That's one of the few pieces of helpful guidance that IRS has provided so far on this topic. But basically, there's not much else to it at this point. So as you see here, it's basically the wild, wild west, unlike the Davis-Bacon Act. There is no federal contracting officer ordering which contract clauses have to be inserted into the prime contract or flowed down to subcontractors. And there's no contracting officer deciding which wage determinations apply to a particular project or how. This is, as we'll discuss later, this is all going to be left up to the owner developer of the project to make these determinations. Similarly, there's currently no statutory or regulatory record keeping or compliance requirements that provide any clarity. We'll talk a little later that there's some very gooey, generic record keeping requirement, but nothing that mirrors the information that Department of Labor regulations typically require for Davis-Bacon Act. Now, the real kicker here, as you see in the third bullet point, is that because this is a tax statute, only the taxpayer, meaning the owner developer, the person who's applying for the tax credit, gets the tax credit incentive. But the prevailing wage requirement applies to both the taxpayer as well as all contractors or subcontractors of any tier who employ laborers and mechanics to do construction or repair work on the project. So let that sink in for a second, because unlike in the federal prevailing wage system where the government can go after any tier of contractor for noncompliance, here only the owner or taxpayer is going to suffer the adverse consequences of noncompliance by either itself or any tier of subcontractor. And this may not be the type of situation where through indemnification clauses or other sort of typical contract vehicles, contract clauses that you can contract away or pass down the liability, because depending on the size of the tax credit at issue, the loss of such a tax credit may be far greater than any construction company or subcontractor could ever potentially indemnify you for. So that, again, creates a lot of really perverse and strange economic incentives here. Similarly, because the Davis-Bacon Act technically doesn't apply, there are no required contract clauses that need to be inserted in any prime contracts or flow-down contracts. So basically here, Congress is leaving it to the developers to figure out how they're going to mitigate the risk, how they're going to manage the risk vis-a-vis all tiers of subcontractors below them in order to maintain the tax credit. Now, what makes this further frustrating and complicated is, who's in charge of enforcement here? Again, as I've said several times before, and it frustrates me as I look at this, having dealt with prevailing wage statutes for 20 some odd years, there is no overt inclusion of Davis-Bacon Act statutory or regulatory requirements in the Inflation Reduction Act. There is no guidance in the IRA as to how taxpayers are supposed to enforce prevailing wage requirements on their subcontractors. And this is the thing that really gets me. The statute itself places the Department of Treasury, or the IRS, in charge of enforcement of the tax provisions, and by implication, whether or not the contractor or any, the taxpayer or any tier of subcontractor has complied with the prevailing wage requirements. Think about that. You have Department of Treasury trying to enforce a labor provision. As I like to joke, it's sort of like going to a podiatrist for a toothache. I wouldn't do that. I wouldn't trust Treasury to properly interpret or imply prevailing wage requirements. But again, ironically, there is nothing in the statute that creates any express or implied delegation of enforcement or regulatory to the Department of Labor. So let's see, what has Treasury done so far on this? Not a whole lot. Treasury has only issued one guidance memo. Here's the link to it. I had mentioned before, it came out in November. The guidance that came out was very nebulous. It touches about record keeping. It just says, yeah, basically you need to keep good records. It doesn't say what records, really. It doesn't say, which wage determinations to select from SAM.gov. It talks in generalities. It says, pick the one for right geographical location. Doesn't say anything about whether it should be for the building, heavy, or any of the other categories of wage determinations. The guidance talks generally about the conformance process, which I talked about earlier. Basically, the Treasury guidance is see Department of Labor. That's all it says, really, in layman's terms. So Treasury is passing the buck as to how the conformance is supposed to work. And then finally, they talk about, they adopt certain Department of Labor Davis-Bacon Act definitions. As I talked before about what does the term wage include, and a couple of those very generic terms like that. But as far as nuts and bolts, compliance, there's really nothing there from the Treasury guidance. So let's talk about the statute for a second. The statute talks about, the prevailing wages are satisfied when the wages are paid, and the taxpayer maintains and preserves sufficient records. Okay, what records? What information is supposed to be kept? And again, this is very nebulous. We're waiting for the other shoe to drop, waiting for Treasury to provide more guidance on this. And so that's a problem. And so Treasury does provide a little bit of guidance. It talks about here that the record keeping can be satisfied, keep such records as the Secretary may time to time prescribe. But Treasury hasn't prescribed anything yet. And it doesn't certainly provide any detail currently as to what type of records need to be maintained. And there's certainly nothing here incorporating Department of Labor's very extensive record-keeping requirements for Davis-Bacon Act generally. So a lot of this information is really nebulous right now. Treasury hasn't thought this through all the way. There's no solid guidance out there. The statute is no help. Thank you, Congress. So this is a little bit of the wild, wild west. But wait, have no fear. Department of Labor is here to help out. Now, I talked to you before that labor has no authority under the statute to enforce the prevailing wage or apprenticeship standards under the Inflation Reduction Act. Well, that's never stopped the Department of Labor before. So here we go. The Department of Labor has already sent out a webpage putting out its guidance on IRA compliance and enforcement. But let me be clear. There is no congressional delegation of authority to the Department of Labor to issue this guidance. And similarly, there's no direct guidance from the IRS right now to follow or comply with Department of Labor guidance. All this suggests that may be coming, but currently, such guidance doesn't exist. So I want to walk you through a little bit about the existing Department of Labor guidance on IRA wage prevailing wage enforcement, because I think it's instructive of where the government may wind up going here, subject to for future twists and turns. So real briefly, this is a quick list that Department of Labor in its guidance page defines all the various types of facilities that will require prevailing wages to be paid. Again, it pretty much tracks one of the first slides I had in the beginning, but this comes straight from Department of Labor's webpage, so you see exactly how labor has been thinking through all these issues for now. All right, so let's talk a little bit more about Department of Labor's guidance. All right, so on Labor's guidance page, they talk about picking wage determinations. They talk about, that they have to apply a wage determination for each geographical location in which the project will be conducted. So for instance, you have a project that's solely contained in one county, and presumably one county is covered by only one wage determination, then it's fine, simple. It's going to be that one wage determination applies. But let's say you have a project that stretches multiple counties, and as a result stretches across multiple wage determinations. Department of Labor's guidance, of course, is saying that you have to apply the wage determination for where the work is going to be actually performed. So again, you don't have a contracting officer telling you exactly which wage determination applies. So it's going to fall to the owner and developer or taxpayer who's seeking the tax credits to come up with to decide which geographic locations apply and to pick the correct wage determination. And that goes to the next point here. What type of wage determination? We're talking building, heavy, highway, residential. The Department of Labor provides very minimal guidance. In its guidance, it does say that solar farms and wind turbine facilities should be heavy wage determinations. They don't provide any explanation or guidance. And if you really can't sleep at night, you want to look at some historical Department of Labor memoranda that define which wage determinations get used where. You don't see solar farms or wind turbine facilities listed anywhere as being included in heavy or building or any of the other specific wage determination types. In other words, this is new territory that labor is trying to squeeze these new types of construction projects into the heavy determination, even though there's been no rulemaking or other official guidance on that issue yet. All right, the next point on this page is, again, a little bit of an eye-opener. It talks about which wage determination applies. Again, if we're talking the federal construction context, the contracting officer attaches a wage determination to the prime contract. That wage determination applies throughout the life of the contract. Okay, that applies here in the first paragraph. When the taxpayer is hiring a contractor to perform work, and the taxpayer includes the most up-to-date wage determination at the time to the prime contractor. And then the prime contractor is then supposed to flow that down to all the tiers of subcontractors. That makes sense. That's analogous. But here's the twist, the next paragraph. If the taxpayer is self-performing the construction, the most updated wage determination available at the time of the work is commenced will be applicable. So, that raises a whole bunch of questions. What phase of the work is going to be applied here for triggering a different wage determination? That's not clear at this time. What type of work are we talking about? The construction phase, the OEM phase, where is the dividing lines? That could be problematic. Similarly, and I see in some of the questions that are popping up, if we're talking about a project with a 10, 20, 30-year lifespan, attaching one wage determination at the start of the construction/OEM contract is probably not going to cut it from Department of Labor's perspective if they ever get their chops here, because typically these wage determinations have a shelf life of 2, 3, 4 years. But if you're going to have one that's going to apply for longer, my guess is that at some point there'll be some guidance issued saying you can't have a wage determination apply that long, and you may need to have to break it out for the construction versus the repair/OEM work. All right. So let's talk a little bit about conformances. Again, this comes from Department of Labor. It doubles down on the guidance that Treasury has already put out. Basically says that if you think there's a job classification that isn't listed in a wage determination, come to us, Department of Labor. We're good guys. We'll figure it out. We'll tell you whether the position should be included. So, all right, moving right along. Also, the guidance very clearly says that Department of Labor's Davis-Bacon Act regulations do not apply. Interesting. So, a lot of the concepts that typically would govern how wages are paid, why wages are paid, how things are calculated, so some of the issues that are typically the battlegrounds for Davis-Bacon Act enforcement stem from the regulations, and those aren't included here according to Department of Labor. Personally, I think Department of Labor is speaking with a forked tongue because at the current time, Department of Labor is updating its Davis-Bacon Act regulations in a way that may give it unilateral authority to decide when its own regulations apply to statutes like this. So stay tuned. Regulations currently don't apply, but we'll see what happens. The guidance then also talks about independent contractors and very clearly says that the prevailing wages apply not just to workers, W-2 workers, but also to 1099 independent contractors. Again, not an earth-shattering concept in the federal contracting space, but the fact that labor has doubled down on that here, they're definitely making a point. And then I'll just skip down payment of fringes, all that other stuff. But talking here about the record keeping, here at Department of Labor's guidance, they're essentially mirroring a lot of the Davis-Bacon Act regulation record keeping requirements in their online guidance for the IRA. This is definitely worth a good hard look going forward. All right, so let's talk about apprentices for a second and prevailing wages. We talked about it before. It only applies to apprentices individually registered in a bona fide apprenticeship program, and under the Inflation Reduction Acts and Department of Labor's guidance, if an apprentice journey work ratio is met on a workday, then apprentices can be paid the percentage of the journey worker wage rate per the apprenticeship agreement requirements. And however, if the required apprentice journey worker ratio is not met, then apprentices must be paid the full journey worker wage for that day. So again, this is the intersection of the two topics we're talking about today. All right, so let me talk about one last piece about prevailing wages. And so in the statute itself, instead of there being typical Department of Labor and government enforcement, Congress laid out the following for how failures to pay prevailing wages can be corrected by the taxpayer in order to theoretically maintain eligibility for the tax credits. And it's fairly simple. Making all workers whole for all unpaid prevailing wages, paying the workers 6% interest on any wage underpayment, and paying a penalty to the Treasury Department at a rate of $5,000 times the number of workers underpaid. So, this is a fairly easy concept if the owner / taxpayer is the one who didn't pay workers properly. But it's going to be an awful lot harder if a second tier or lower tier sub didn't pay it, because it's all going to depend on the contract clauses and the flow downs and enforcement you have with the lower tiers. All right, let's talk about Inflation Reduction Act and apprenticeship. Again, it just says that work has to be done by apprentices, not less than the applicable percentage of the total work hours. So you may ask yourself, what are the applicable percentages? Well, this Congress set forth exactly what they were. And for construction beginning January 1st of 2023 through the end of this year, that apprentices must perform at least 12.5% of the total labor hours on the project. And after January 1st of next year, that goes up to 15%. So, okay, how is this again under the Inflation Reduction Act? It also expressly says that each taxpayer, contractor, or subcontractor who employs 4 or more individuals to perform construction work shall employ 1 or more qualified apprentices to perform the work. In other words, if you have a work crew of more than four workers, you need to have an apprenticeship program in place. And it has to be an apprenticeship program registered with the Department of Labor or applicable state apprenticeship agency. And the apprentice to journey worker ratio is typically set by those apprenticeship programs. So you're somewhat at the mercy of those apprenticeship programs to set your workforce ratios. So let's talk about here about, again, Treasury and IRS has tried to provide some guidance here. It's not very helpful. It's the same guidance memo I talked about before. Again, very nebulous guidance regarding record keeping, adopt certain definitions from Department of Labor, and give some very generalized examples of compliance, but nothing really helpful. So again, once again, Department of Labor rides the rescue. Department of Labor has its own web page for apprenticeship requirements for the Inflation Reduction Act. And it provides a series of guidance here. But let's talk about here, based on the Department of Labor's webpage, here's some of some compliance issue spotting issues that you should be aware of going forward. Obviously, it's going to be a question of finding the right apprenticeship programs based on the trades that you're using and are required for the job, and based on the triggers in the statute itself. If you have 4 or more workers, then you have to have the apprenticeship program. You only have apprenticeship programs for apprenticeable occupations as defined in the regulations. There may be available programs out there. There may not. You may need to create a new registered apprenticeship program to cover whatever kind of new trades are required for the type of work that's going to be performed. You have to keep in mind the effect on wages for an insufficient number of journey workers on site. Again, if you don't meet the proper ratios, then Department of Labor's guidance says you have to pay the apprentices the full journey worker wage. And so there are also going to be costs associated with setting up and participating in a new apprenticeship program. So, assuming that you try to make good faith efforts, you always want to make good faith efforts comply. And Congress, when they wrote the statute, built in a good faith effort exception for noncompliance. Basically, you can demonstrate good faith effort if you requested apprentices from a registered program, but none were provided for certain delineated reasons. And is there a way to correct it? Sure, there's a way to correct any failures to comply with apprenticeship requirements. Sort of a two-tiered. To the extent that there was a good faith effort to comply, but you still didn't comply, then the statute requires that the taxpayer pay $50 times the total labor hours in the project as a penalty to correct it. And to the extent that there was intentional disregard of apprenticeship requirements, and that's defined in the statute as well, then there is a $500 penalty times the total labor hours on a project. Depending on the size of the project, that could be a very, very large bill to pay to correct those issues. Okay, so let's talk here in the last 10 or so minutes about some practical advice. And going forward here, what do you do in this wild, wild west environment? So again, advanced planning, sitting down with counsel, sitting down with accountants, sitting down with other folks who are stakeholders to figure this thing out ahead of time is definitely the smart way to go. Despite all the doom and gloom in my presentation, none of this stuff is particularly hard. It simply just requires a certain degree of intentional planning ahead of time. To sort of think through all the traps and think through all the potential issues and put your best foot forward. So among that is to select the proper wage determinations for each phase of a project. Obviously, if there's a construction phase, then if that's easily segregable, then that's going to be easy enough. If you have an OEM or some kind of repair contract scheme, then you have to sort of figure out how to select the proper wage determinations for that. Similarly, depending on what the phase of the project is or what the work is itself, it may dictate a different type of wage determination. It may not be heavy. It may be building. We'd have to see on a very case by case, situation by situation perspective to see which wage determination could apply. All right, and you're obviously going to need to evaluate the job classifications necessary for a project, and proactively pursue conformances as needed. Again, the idea typically for conformances is that you approach the Department of Labor before work is started to ask for the conformance, rather than halfway through and go, "Oops, we made a mistake," or "we overlooked this." Always better to make those asks before the work is commenced, for a number of reasons, both to get the Department of Labor buy-in and blessing, and then number two, just so you have a better handle on the costs involved, so you know exactly what wages and fringes you're paying for the workers going forward. The big one here, create contractual compliance scheme for subcontractors at all tiers. Because there are no FAR clauses or Department of Labor contract clauses that you can just slot in here, because that Davis-Bacon Act scheme doesn't really apply, because that scheme talks about government down compliance and enforcement. It require creating a contractual compliance scheme for subcontractors that embodies the Davis-Bacon Act and apprenticeship concepts, pushes them down to prime contractors and subcontractors of all tiers, requires your contractors to push them down to subsequent tiers, to lower tiers of contractors, and also to build in some kind of audit function to allow the taxpayer, the entity seeking the tax credits, to actively be able to, on a regular basis, audit and make sure that the contractors and subcontractors of all tiers are complying. Because the last thing you want to do is find out after you're several years in and several $1 billion of investment in that, gee, this third tier subcontractor who was doing duct work didn't pay proper prevailing wages, and I could lose all the tax credits based on a couple $100,000 worth of work. You need to take proactive steps to make sure that you can prevent that kind of stuff from happening. Similarly, part and parcel with that is to establish defensible record keeping. That you want to push that requirement down on all the contractors and subcontractors, have an audit ability to go in, make sure they're doing good record keeping, so that if push comes to shove, you can, and IRS questions it later, you can, make sure that that the records are there to support your claims that the compliance was proper. And again, you want to make sure that contractors are flowing down the compliance requirements to lower tier subs, and to rigorously enforce this stuff. Now, you may also, at least in the short term, to the extent you can, and you may not be able to in all jurisdictions, you may want to try to use contractors and subcontractors who are already familiar with the Davis-Bacon Act, who already do because for them, this compliance stuff will be almost second nature, and you can sort of work with them a little bit easier to work up compliance, and that'll mitigate some of your risks. But to the extent you're dealing with in areas of the country where there are not federal contractors, or there just isn't critical mass of folks out there, and you have to work with a company that's never done this before, that's where the risks really lie, and that's where the issues are going to arise in this case. Again, because this is a tax statute, and the tax burden falls on the parties seeking the tax credit, that's the party that is going to be liable for all subcontractor noncompliance further down the tier. So that's the entity that's going to want to make sure that everybody down in the contractual chain below is in full compliance. And so what are the unknown factors here? Is there going to be private causes of action by employees seeking enforcement of prevailing wages? There might be. The Davis-Bacon Act itself provides for exclusive federal administrative enforcement, meaning there is no private cause of action for disgruntled employees who think they were underpaid. But because the Davis-Bacon Act doesn't apply, it's very possible there could be wage claims, lawsuits filed against contractors of all tiers for noncompliance with this. Question of who's going to be winding up enforcing this? Is IRS going to pass the buck to Department of Labor? How is this going to work? That's still very unclear. And how closely will they attempt to hold taxpayers to this stuff at this point in time? All right. So some of the same sort of issues apply here on the apprenticeship front as well. Again, proactive planning and planning and contracting is going to be very important here. You want to start surveying the classifications of trades that will likely be used in A-covered projects, and to start looking for registered apprenticeship programs in the various jurisdictions and where you're going to be doing work, typically through construction trade associations or unions, to see if these apprenticeship programs even exist. You may need to establish some depending on the scope of the work, and that's going to take some lead time as well. You have to be, and then if the programs exist, you have to start discussions to become a sponsor or member, and or to enable subcontractors to be able to do so. And then finally, you have to actively plan to make sure you have an adequate apprenticeship workforce so that your apprentice to journey worker ratios are proper. Otherwise, you could be unintentionally walking into prevailing wage issues by requiring, if you don't have adequate apprentice coverage, all the apprentices may wind up having to be paid the full journeyman wage. So a lot of this stuff, again, comes down to a question of subcontract enforcement. What kind of contract terms you're going to put down in the prime contract and flow down to all the tiers, and how do you establish an audit program to ensure that the lower tiers are fully compliant going forward. Because again, all it takes is one subcontractor to screw it up, and theoretically the taxpayer seeking the tax credits could be denied those. And this is given the size of the tax credits at issue, a small subcontractor could even begin to cover the losses, even assuming you could contract and to push down the risk onto them. So again, as before, there are a lot of unknown factors. We don't know what IRS is going to do. We don't know what labor is going to do going forward. So there are a lot of unknowns at this point in time, because Congress passed this statute. It makes for good it makes for good policy, I guess, from a certain perspective, to have prevailing policy. But it does not appear that Congress thought this thing through all the way. And it certainly does not appear that the IRS or Department of Labor has thought this thing through all the way as to how this is going to get enforced and how this tax statute is being enforced in a way that it's not going to create unpleasant surprises for owners, developers going forward. Because as any good business, you want to be able to identify and mitigate risk going forward. But the current regulatory structure and landscape really doesn't permit that at this time. We can make best efforts to mitigate it through good contract drafting and issue spotting, and try to take proactive steps akin to Davis-Bacon Act and general apprenticeship standards in general. But until we get some definitive language out of DOL or IRS, your guess is as good as mine as to which way this will ultimately swing. So I want to thank you all for your time. I know I've gone a couple minutes over. I do appreciate your time. So I see that there have been a bunch of questions. I apologize, we're out of time, but I will attempt to respond to the questions offline and try to email you. And if it's questions of general interest, I will try to send it to all attendees. But let me read from my official script here. Thank you for joining me today. I hope the information was helpful to you and your organization. As a reminder, this program has been approved for legal education hours in certain jurisdictions. To report your hours, click on the CEU icon at the bottom of the screen. A certificate of attendance, including course numbers, will be emailed to you tomorrow, along with a recording of the webcast for watching and sharing. Be sure to complete our short survey. We use your feedback to plan future programs that are applicable to your business needs. This concludes the webinar. Thank you for your time today. I'm sure you all have many more questions, and we'll talk to you all shortly.